I need to tell you about something I am seeing right now in the market that I have only seen maybe 3 or 4 times in my entire career. And I've been investing since 1942. That is over 80 years of watching markets, studying businesses, analyzing balance sheets, and waiting patiently for moments exactly like this one. What I am seeing right now are 2 dividend-paying companies that are trading at prices that make absolutely no sense, given the quality of their businesses, the durability of their cash flows, and the size of the dividends they are paying. These are not speculative bets. These are not meme stocks. These are not companies that might be great someday if everything goes right. These are established, dominant businesses with decades of proven performance that the market has temporarily mispriced because investors are panicking about things that will not matter 5 years from now, let alone 10 or 20. And when I say once in a decade, I mean it literally, the last time I saw opportunities like this was during the financial crisis of 2008 and 2009. Before that, you would have to go back to the early 2000s after the dot-com bust. These windows do not open often, and when they do not stay open for long. So today I am going to walk you through exactly what I am seeing, why these 2 companies represent extraordinary value, and why the dividends alone could change your financial future if you have the courage to act while everyone else is running scared. Let me start with a story that explains how I think about dividend investing, because it is fundamentally different from how most people approach it. Back in 1988, I made one of the most important investments of my career. I started buying shares of a company that most people thought was boring, old-fashioned, and past its prime. Wall Street analysts were saying the company's best days were behind it. Growth investors wanted nothing to do with it. The stock was trading at a valuation that suggested the market thought this business was slowly dying. I bought $1.3 billion worth of shares. That was an enormous position for us at the time. People questioned my judgment. Some said I was being sentimental. Others said I was losing my touch. But I was not looking at what the stock had done recently. I was looking at the business underneath the stock. I was looking at the cash flows, the competitive moat, the brand value, the distribution network, and most importantly, the dividend. That company has now paid me over $750 million per year in dividends. The annual dividend income alone is more than half of what I paid for the entire investment nearly 4 decades ago, and I still own every single share, which are now worth roughly $25 billion. That is what happens when you buy a great dividend, paying business at the right price, and then simply hold it. The dividend grows every year, the shares appreciate, and the compounding creates wealth that would have seemed impossible when you first made the purchase. This is the lens through which I want you to view the 2 opportunities I am about to share with you. I am not looking for stocks that will double next month. I am looking for businesses that will pay me growing dividends for the next 20 or 30 years. Businesses where the dividend alone will eventually return my entire investment many times over. And right now, I am seeing 2 companies where the setup is almost identical to what I saw in 1988. Before I tell you about these 2 specific opportunities, let me explain the framework I use to evaluate dividend investments, because this will help you understand why these 2 companies stand out from the thousands of dividend-paying stocks in the market. I look at 5 things when evaluating a dividend opportunity. First, I want a dividend that is safe. This means the company is paying out less than 60 to 70% of its free cash flow as dividends. If a company is paying out 95% of its cash flow, there is no margin of safety. 1 bad quarter, and the dividend gets cut. And a dividend cut is the worst thing that can happen to a dividend investor because it destroys the entire compounding thesis. Second, I want a dividend that is growing. A static dividend is not enough. I want to see a track record of consistent dividend increases, ideally for 10 years or more, preferably 20 or 30. Companies that increase their dividends every year are telling you something important. They are telling you that management is confident in the future of the business, that cash flows are strong and growing, and that they prioritize returning capital to shareholders third. I want a business with a genuine economic moat. something that protects it from competition and gives it pricing power. Without a moat, even the most generous dividend is at risk, because competitors will eventually erode the profit margins that fund the dividend forth. I want a reasonable valuation. A great business at a terrible price is still a bad investment. I want to buy when the market is offering me a dividend yield that is significantly above the company's historical average. That tells me the stock is cheap relative to its own history. And fifth, I want a catalyst for recovery, something that will eventually cause other investors to recognize the value and push the stock price back up. Not because I need the price appreciation, the dividends alone would justify the investment, but because a recovery in the stock price accelerates the total return and confirms the thesis. Now, I want to be very clear about something. I am not looking for stocks that will double overnight. I am not making predictions about where oil prices will be next quarter or what the Federal Reserve will do at its next meeting. I have never been able to predict short-term market movements, and I have stopped trying decades ago. What I am doing is identifying businesses where the current price gives me an extraordinarily attractive entry point for a long-term dividend compounding strategy. Businesses where even if the stock price goes nowhere for 5 years, the dividends alone will generate returns that are competitive with or superior to what most investors achieve in the stock market. And if the stock price does recover to something closer to fair value, which history suggests it eventually will, the total returns will be exceptional. With that framework in mind, let me tell you about the first opportunity. The first once in a decade dividend opportunity is in the energy sector. Now, before you roll your eyes, hear me out. I know energy stocks are controversial. I know people worry about the transition to renewable energy. I know the environmental concerns are real and important, but here's what most investors are missing entirely. The world still runs on oil and natural gas, not in some theoretical future right now today, and it will continue to do so for decades to come. Regardless of how fast the renewable transition happens, the International Energy Agency projects that global oil demand will not peak until at least the early 2030s, and natural gas demand will continue growing. Well beyond that. Let me tell you a story that illustrates why the market gets energy wrong cyclically. Back in 1999, the price of oil dropped to about $10 a barrel. $10. The covers of major financial magazines were declaring that oil was finished, that the world would never need as much oil again, that new technologies would make fossil fuels obsolete within a decade. I remember reading those articles and thinking, these people have lost their minds. The world was consuming about 75 million barrels of oil per Dalton Y. The population was growing. Developing nations were industrializing at an unprecedented rate. The math simply did not support the idea that demand would collapse. Sure enough, over the following decade, oil prices rose from $10 to nearly $150 a barrel. The companies that were left for dead in 1999 became some of the best investments of the 2000s. I see a very similar dynamic playing out today, not with the same magnitude perhaps, but with the same pattern of irrational pessimism creating extraordinary opportunity. Meanwhile, the major energy companies have spent the last several years doing something remarkable. They have completely transformed their capital allocation. Instead of spending every dollar they earn on drilling new wells and chasing production growth the way they did in the 2010s, they have become disciplined capital allocators. They are generating massive free cash flow. They are paying down debt. They are buying back shares, and they are paying enormous dividends. This is a fundamentally different energy sector than what existed 5 or 10 years ago. These companies learned hard lessons from the price collapse of 2014 through 2016. And again, during the pandemic crash in 2020, they learned that chasing production growth at the expense of shareholder returns was a losing strategy, and they have completely reversed course. I am looking at major integrated energy companies right now that are trading at single-digit price to earnings ratios. Single digits. These are companies generating tens of billions of dollars in free cash flow every year, paying dividend yields of 4 to 5%, buying back 5 to 7% of their shares, outstanding annually and sitting on balance sheets that are the strongest they have been in decades. The dividend payout ratios are below 40% of free cash flow. That means even if oil prices drop 30% from here, these dividends would still be safe. They could sustain these payouts through a severe recession without touching the dividend. And the dividend growth has been extraordinary. Some of these companies have increased their dividends by 50 to 70% over the last 3 years alone. Now, here is why this is a once in a decade opportunity. The market is pricing these companies as if oil demand is going to collapse next year. But the data says the opposite. Global demand is at record highs. Supply growth is constrained because companies have been disciplined about capital spending. And the geopolitical landscape, with tensions in the Middle East and supply disruptions from various regions, adds a risk premium to energy prices that benefits producers. There is another factor that most investors are completely ignoring. The supply side of the equation has fundamentally changed. For the past decade, the major energy companies have dramatically underinvested in new production. They have been pressured by shareholders, by environmental groups, by governments to reduce capital spending and return more cash to investors. And they have done exactly that. But the consequence of a decade of underinvestment is that supply growth is now severely constrained. Existing oil fields naturally decline in production by about 4 to 6% per year. Without constant reinvestment, output falls. And the new projects that are needed to replace that declining production take 5 to 10 years to develop. This creates a structural supply deficit that will persist for years regardless of what happens with demand. It is simply the physics of the oil and gas industry. You cannot turn on new supply with the flip of a switch. What this means practically is that energy prices are likely to remain at levels that are very profitable for these companies for years to come. And at current prices, these stocks are being valued as if energy companies are going out of business. The disconnect between the actual cash flows these businesses are generating and the prices the market is assigning to them is the widest I have seen since 2020, and arguably since 2008. Let me put this in concrete terms. If you buy one of these major energy companies today at a 5% dividend yield, and the company continues growing its dividend at even 8% per year, which is well below recent growth rates, in 10 years you will be earning a yield on your original investment of over 10%. In 20 years, over 22%. You will literally be earning back more than a fifth of your original investment every single year just from dividends. And meanwhile, the stock price will almost certainly be higher because the underlying business is generating more cash flow, buying back shares, and becoming more valuable over time. I bought a major energy company during the depths of 2020 when oil prices briefly went negative. That investment has roughly tripled since then, and the dividend has more than doubled. But even at today's higher prices, these companies are still extraordinarily cheap relative to their earnings power, their free cash flow, and their dividend capacity. The second once in a decade dividend opportunity is in the financial sector. Specifically, I am looking at large, well-capitalized banks that have been punished by the market far beyond what their fundamentals justify. Now, I understand why people are nervous about banks. The regional banking crisis in 2023 scared a lot of people. Silicon Valley Bank collapsed. First Republic collapsed. Signature Bank collapsed. And suddenly everyone was worried that the entire banking system was fragile. But here's what actually happened. The large money center banks, the ones I am talking about, actually got stronger during that crisis. They absorbed deposits that fled from smaller banks. They gained market share. Their competitive positions improved, and their earnings have been extraordinary. I know something about banks. I have been studying financial institutions since the 1950s. I owned a bank in Illinois decades ago. I have invested in banks throughout my career, and sometimes spectacular success, and occasionally with painful lessons. And one thing I've learned is that the time to buy banks is when nobody else wants to own them. When the headlines are screaming about banking crises and defaults and deposit runs, that is precisely when the best banks become available at the most attractive prices. Let me give you a specific example from history. In 2009, at the absolute depths of the financial crisis, we invested $5 billion in a major bank through preferred shares with warrants. People said we were insane. The banking system was in free fall. But we looked at the specific institution, analyzed its capital position, assessed its management quality, and concluded that it would not only survive but thrive on the other side of the crisis. That investment has generated billions of dollars in profits for us. Not because we were brave, because we were analytical. We looked at the numbers when everyone else was looking at the headlines. I am looking at major banks right now that are trading at 7 to 9 times earnings. Some are trading below their tangible book value, which means you are buying the business for less than the liquidation value of its assets. These banks are paying dividend yields of 3 to 4%, buying back significant amounts of stock, and sitting on capital ratios that are well above regulatory requirements. The dividend payout ratios are typically 30 to 40% of earnings, leaving enormous room for continued dividend growth. Here is what most people do not understand about bank dividends. When a bank earns a 15% return on equity, pays out 35% as dividends, and uses another 15% for buybacks, the remaining 50% of earnings is retained and added to the equity base. That retained equity then earns another 15% the following year. This creates a compounding flywheel that is incredibly powerful over time. The equity base grows, earnings grow, dividends grow, and the share count shrinks from buybacks. Everything compounds simultaneously. I call this the triple compounder effect, and it is one of the most powerful wealth building mechanisms I have ever seen in any industry. And right now, the market is giving you the chance to buy into this compounding machine at prices that assume something is seriously wrong. What could be wrong? Interest rates are high, which is actually good for bank net interest margins. Credit quality has been better than expected. Loan demand is stabilizing. Investment banking revenues are recovering. And regulatory clarity has improved after the uncertainty of the past couple of years. The risks that people are worried about, a recession causing loan losses, commercial real estate exposure, further interest rate movements. These are all legitimate concerns, but they are already priced into these stocks at 7 to 9 times earnings. The market is pricing in a recession that may never come, or if it does come. These banks have more than enough capital to absorb the losses and keep paying their dividends. Let me be specific about why I think the commercial real estate concerns, which is the biggest worry for bank investors right now, are overdone for the large money center banks. Yes, commercial real estate, particularly office buildings, is under severe stress. I have talked about this before, and I do not sugarcoat the problems. But here is what people miss. The large banks have relatively modest exposure to commercial real estate as a percentage of their total loan portfolios. We are talking about 5 to 8% for most of the largest institutions. And even within that exposure, a significant portion is performing just fine. Industrial properties, data centers, multifamily housing and supply, constrained markets, these are all healthy segments. The problem loans are concentrated in office buildings in specific markets. And even worse, case loss estimates on those portfolios would reduce earnings by maybe 5 to 10% for a year or two. That is not a crisis. That is a manageable headwind. And it is certainly not enough to justify valuations that are 30 to 40% below historical averages. The market is treating these banks as if commercial real estate losses are going to wipe them out. The math simply does not support that narrative. Let me share some history that puts this in perspective. During the financial crisis of 2008, the very worst banking crisis in modern history, the large money center banks that survived emerged as dominant franchises. Their stock prices had fallen 80 to 90%. But if you bought them at the depths of the crisis and simply held them reinvesting the dividends, Your returns over the following 15 years were absolutely extraordinary. We are not in anything close to a 2008 situation today. The banking system is far better capitalized. The regulatory framework is much stronger. The stress tests are more rigorous. But the valuations on these banks are approaching levels that suggest a similar level of distress. That disconnect between reality and market pricing is what creates a once-in-a-decade opportunity. Now let me bring these two opportunities together and explain why the combination is so powerful. When you own dividend-paying stocks in both the energy and financial sectors, you are creating a portfolio with several important characteristics. First, the dividend yields are high, ranging from 3.5% to 5% combined. That means you are immediately earning meaningful income on your investment. Second, the dividend growth is strong. Both sectors are increasing their payouts at rates well above inflation. Third, the valuations are low, providing a margin of safety that protects you even if things do not go perfectly. And fourth, the two sectors tend to perform differently in various economic environments, providing natural diversification. Energy does well when inflation is elevated, and economic growth is strong. Banks do well when interest rates are reasonable and credit demand is healthy. By owning both, you are positioned to benefit in multiple scenarios. I also want to emphasize something about the psychological advantage of dividend investing that does not get discussed enough. When you own stocks that pay you regular, growing dividends, it completely changes your relationship with market volatility. When the market drops 10 or 15%, most investors panic. They see their account values falling and they feel compelled to do something, usually selling at exactly the wrong time. But dividend investors have a completely different experience. When the market drops, yes, your account value declines temporarily, but your dividend income does not change. Those quarterly payments keep arriving like clockwork. And in fact, if you are reinvesting dividends, a market decline is actually beneficial because you are buying more shares at lower prices, which accelerates the compounding. This psychological advantage is worth more than most people realize. It is the difference between staying invested through a downturn and panicking out at the bottom. It is the difference between building wealth over decades and constantly resetting your compounding clock by selling and buying at the wrong times. The dividend income acts as an emotional anchor. It reminds you every single quarter that these are real businesses generating real cash and sharing it with you. That tangible, regular income makes it so much easier to be patient during volatile markets. But the real magic, and this is what I want to emphasize more than anything, is what happens when you reinvest those dividends over time. Let me walk through the math because I think it will shock some of you. If you invest $100,000 split evenly between these two sectors, earning a blended dividend yield of 4%, and those dividends grow at 8% per year, here is what happens. In year one, you receive $4,000 in dividends. Nice, but not life. Changing in year 5. Your annual dividend income has grown to about $5,800. In year 10, you are receiving about $8,500 per year. In year 15, about $12,500 in year 20, about $18,400. And in year 25, you are receiving about $27,000 per year in dividend income from your original $100,000 investment. That is a 27% annual yield on your original cost. But here is where it gets truly extraordinary. If you reinvested every single one of those dividends along the way, buying more shares, which generate more dividends, which buy more shares, your total portfolio value after 25 years would be approximately $800,000. And your annual dividend income would be over $43,000 per year. From an original investment of $100,000, that is the compounding miracle of dividend investing. And the key, the absolute critical ingredient, is buying when yields are high and valuations are low, which is exactly the opportunity I see right now. Let me address the objections because I know what some of you are thinking. You are thinking that energy is a dying industry. You are thinking that artificial intelligence will disrupt banks. You are thinking that there must be a reason these stocks are cheap. And you are right to ask these questions. Healthy skepticism is essential in investing. But let me push back on each of these concerns. Energy is not dying, it is transforming. The same companies I am talking about are investing billions in renewable energy, in carbon capture, in hydrogen. They are adapting, and meanwhile, they are throwing off cash from their existing operations at rates that would make any technology company envious. Consider this simple fact. The world consumes about 100 million barrels of oil per Dalton Y. 100 million barrels every single day. Even the most aggressive transition scenarios show that number declining very gradually over the next 2 decades. These companies do not need demand to grow. They just need it to stay roughly where it is. And at current valuations, you are being paid handsomely for that very modest assumption. As for banks being disrupted by fintech or AI, the large banks are actually the biggest investors in these technologies. They are using AI to improve fraud detection, to streamline operations, to personalize customer experience. Technology is not their enemy. It is their competitive advantage. The banks with the most resources to invest in technology are the large ones, which is exactly where I see the opportunity. I have watched predictions of the death of traditional banking for 30 years now. First, it was online. Only banks that were going to destroy the traditional model. Then it was mobile payments. Then it was blockchain and cryptocurrency. Then it was fintech lending. And through all of it, the large banks have adapted, evolved, and emerged stronger. Their deposit franchises, their regulatory moats, their scale advantages, these are not easily disrupted. If anything, technology has made these advantages more powerful, not less. And as for why these stocks are cheap, the answer is simple. Investor sentiment. Everyone wants to own technology stocks. Everyone wants exposure to artificial intelligence in the future economy. Nobody wants to own boring energy companies or traditional banks. And when nobody wants to own something, the price goes down regardless of the fundamentals. That is when I get interested. That is when I start buying. I've always said that I like to be fearful when others are greedy and greedy when others are fearful. Right now, the market is greedy about technology and fearful about energy and banks. So I am looking very seriously at energy and banks. I have seen this pattern play out dozens of times in my career. The market falls in love with one sector and ignores everything else. The ignored sectors get cheaper and cheaper until they are absurdly undervalued. And then inevitably the market rotates back. The unloved becomes the loved, the cheap becomes expensive. And the investors who had the courage to buy when nobody else wanted to are the ones who profit enormously. This is the opportunity I see right now in energy and financial dividends. The market has left these sectors for dead while chasing technology. The dividends are high, growing, and safe. The valuations are at or near decade lows, and the businesses underneath these stocks are generating record levels of cash flow. I remember a conversation I had with my partner many years ago about this exact phenomenon. We were discussing a situation where a perfectly good company was trading at a depressed price because its entire sector had fallen out of favor. He said something I have never forgotten. He said the stock market is the only market where when things go on sale, everyone runs out of the store. And he was right. In every other area of life, people love a bargain. When your favorite restaurant offers a discount, you go more often. When a car you have been eyeing drops in price, you buy it. But in the stock market, falling prices cause panic. People sell precisely when they should be buying. And that irrational behavior is what creates the kind of opportunities I am describing today. These are not speculative bets on unproven companies. These are proven cash-generating businesses with decades of dividend history, trading at prices that assume the worst-case scenario. When the worst case is already priced in, the risk is actually much lower than people think. And the upside from both dividend income and eventual price recovery is much higher. I want to leave you with something my partner used to say. He said, the big money is not in the buying or the selling, but in the waiting. That is especially true with dividend investing. The beauty of buying high-quality dividend stocks at low prices is that you get paid to wait. Every quarter, those dividend checks arrive in your account every year. Those dividends grow. And over decades, the compounding turns modest investments into extraordinary wealth. You do not need to time the market perfectly. You do not need to guess which way interest rates are going. You do not need to predict the next recession. You just need to identify great businesses paying growing dividends at attractive prices, buy them, reinvest the dividends, and then do the hardest thing in all of investing. Nothing. Just sit there and let the compounding work. Let me tell you what this looks like in practice, because I think the real world experience of dividend compounding is even more compelling than the math. When you own a great dividend stock, the early years feel almost insignificant. You collect your 3 or 4% yield and you think, this is hardly worth the effort. But then year 5 comes along and your yield on cost is 6%, year 10 and it is 9%, year 15 and it is 13%. And somewhere around year 12 or 15, something magical happens. Your annual dividend income starts exceeding the amount you originally invested. Let that sink in. The dividends alone, not the stock price gains, but just the cash payments, are returning more than 100% of your investment every 7 to 8 years. That is what happened with my beverage company investment. That is what happened with many of my best investments over the decades. And that is exactly what I believe will happen with these two opportunities. If you buy them today and simply hold, I have been doing this for over 80 years. It is not exciting. It will never make for interesting conversation at a dinner party, but it works. It has always worked, and it will continue to work for anyone with the patience and discipline to see it through. These two opportunities will not last forever. Once in a decade means exactly that. The window opens, and then it closes, and the people who had the conviction to buy when prices were low and fear was high, those are the people who build real lasting wealth, not the ones who waited for more certainty. Because in investing, certainty and cheap prices never arrive at the same time. That is a lesson I learned at 11 years old, and it has proven true every single day since.